This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Oil prices stabilized on Monday after last week's decline of about 3%, as investors weighed the chances for a U.S. rate cut against the prospect of a Ukraine peace deal that could lead to an easing of sanctions on major producer Russia. The United States and Ukraine were set to resume work on a revised peace plan ahead of a Thursday deadline set by U.S. President Donald Trump, after agreeing to adjust an earlier version that critics said was too favorable to Moscow. Brent crude futures inched up 12 cents, or 0.2%, to $62.68 per barrel by 1300 GMT, while West Texas Intermediate gained 11 cents, or 0.2%, at $58.17 a barrel.
Russian state oil and gas revenue may fall in November by around 35% from the corresponding month in 2024 to 520 billion rubles, $6.59 billion, due to cheaper oil and a stronger ruble, Reuters calculations showed on Monday. The decline in proceeds is painful for Russia, which has heavily boosted defense and security spending since launching its military campaign in Ukraine, which it calls a special military operation, in February 2022. Oil and gas revenue has been the most important source of cash for the Kremlin, making up a quarter of total federal budget proceeds.
Moving on to the top news in the energy sector.
Licenses to supply methanol as a marine fuel in the world's largest bunker port, Singapore, will be issued from January 1, 2026, the Maritime and Port Authority of Singapore, MPA, said in a statement on Monday. This marks a key step towards establishing methanol bunkering at scale and driving Singapore's ambition to be a sustainable multi-fuel bunkering hub, the MPA said. The move follows a call for applications launched in March 2025. The licenses will go to 3 bunker supplier companies: Global Energy Trading, Golden Island, and PetroChina International Singapore.
China has received 2 more cargoes of liquefied natural gas from Russia's Arctic LNG 2. LSEG and Kepler data showed, taking to 16 the total number of shipments, despite US and EU sanctions imposed on the project over Moscow's war in Ukraine. The Voskhod tanker delivered a cargo from Arctic LNG 2 to the Beihai LNG terminal in China's southwestern region of Guangxi on November 20, the data showed. Shipping database Aquasis lists its registered owner as LNG Beta Shipping, and its ship or commercial manager as Igarka, both with registered addresses in Moscow. Next, we have the top news in metal markets. European Union ministers on Monday were set to urge top U.S. trade officials to apply more of the July EU-US trade deal by cutting U.S. tariffs on EU steel and removing them from EU goods such as wine and spirits. U.S. Commerce Secretary Howard Lutnick and U.S. Trade Representative Jameson Greer were due to meet EU ministers responsible for trade for 90 minutes over lunch in their first trips to Brussels since taking office. Ahead of that meeting, the European ministers gathered to discuss pressing trade issues, including Chinese rare earth and chip export restrictions.
Copper inventories in warehouses approved by the U.S. COMEX exchange have exceeded 400,000 short tons for the first time, as a favorable price arbitrage continues to draw metal into the United States. Copper prices on the London Metal Exchange, LME, are currently around $10,760 per metric ton, whereas COMEX copper prices are at 5 cents per pound, or around $11,023 per metric ton, meaning arbitrage shipments to the United States are profitable. COMEX copper stocks were at 402,876 short tons, 365,483 metric tons, as of November 21, exchange data showed, beating the previous record of 399,458 short tons in January 2003 after quadrupling this year.
We will now look at the top news in the agricultural sector.
Malaysian palm oil futures fell for 3 consecutive sessions on Monday, ending at a 21-week closing low as a stronger ringgit and weak demand weighed down on the contract. The benchmark palm oil contract for February delivery on the Bursa Malaysia Derivatives Exchange lost 14 ringgit, or 0.34%, to 4,055 ringgit, $979.71, a metric ton at closing, its lowest closing since July 1st. The contract ended lower due to pressure from a stronger ringgit, the currency of trade, while export demand was anemic amid large October-end stocks, said Paramalingam Subramaniam, director at Selangor-based brokerage Pelinding Bestari.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.